Hello guys, welcome back. In this video we are going to talk about a company that was suggested by one of our viewers and subscribers, a very interesting one which could be an interesting play during this period in which the stock market is kind of crumbling a little bit, going down some days, it's kind of trading sideways. This may be a company that could potentially serve as an interesting anti-inflationary measure potentially. So you may have heard of this company behind well-known mattresses like Tempur, I think is one. It's selling pillows, mattresses and things of that sort. It's a known company, an old IPO, 2003 is when they had their IPO days. And it seems to be moving a lot actually, high beta here. Now let's examine the stock analysis chart and the ratios that we're getting here. This is a company that deserves a little bit of a breakdown here, and we will talk about some things like the working capital and how the changes of that affect cash flow and what we should be looking at. And what is happening in terms of this company, you will see it's been down about 50% from its 1 year high. About 25 is the current price. And if we take a look at the 5-year period, you will see that it's generally been going upwards and just lately with the rest of the stock market going downwards. Now, the nice thing about this company is the P ratio and price to free cash flow ratio. Not only they are rather low here, they are also similar to each other, and you want to see that, of course. You want to have free cash flow actually follow profitability if possible. And this kind of company you do want to be buying at a low ratio of that sort also. That's because these kinds of companies like retailers, pretty much companies that are heavy on inventory and things of that sort, they tend to be trading better at lower multiples. You want to be buying them at lower multiples. This will, generally speaking, do you better in the long run. You probably don't want to buy them when they are near 30 or so, or 25 or so. This may be fine for a tech company, but probably not fine for this kind of company. Now, the company has been buying back shares. That's awesome to see, and has been buying back shares a lot in the past 6 months or so, as you will see, or less than that even. So you will notice a significant decrease in the total equity of the company because they have been buying back shares. When you do that, you are actually allocating some part of your cash in order to decrease the equity of the company because you are buying back some shares using that cash, but you have less shareholders sharing that amount of equity right now. And so this is a good thing because if you bought earlier, you bought at a lower price compared to the lesser amount of stock, yet you are getting the same amount proportionally in terms of equity. It's not the absolute value that is the same, but proportionally you are getting the same really, and so practically speaking is more for you because you bought earlier. And so the total liabilities to free cash flow points to the fact that we may have some extra liabilities here compared to what the company is making in terms of free cash flow. We will examine these things in a little bit more detail. This company is one that can actually help us understand some things about how to read through the lines about these companies and how they're doing, using the financial statements, which can give us a lot of nice clues about how the company is operating. Now, the 5-year revenue growth, net income growth, free cash flow growth is doing well, and has been increasing here for pretty much the top and bottom lines here, and free cash flow. And total equity as well has been increasing, but there is a little bit of an asterisk here, which again we will examine in the financial statements. You can kind of get a preview by looking at this price to book value here, which is negative. It turned negative abruptly. So we'll examine what happened. And the same thing with the debt to equity ratio is still kind of high here, pointing to potentially a lot of debt compared to the equity. And this is negative actually because it takes the value out of the very, very last quarter, as you'll see here. That's June pretty much. And the debt to equity ratio is actually a little bit earlier. It has to do with the financial statement. And I thought it's nice to have both here because you can discover the discrepancies and see what has changed. This is a little bit of an extra that you can spot using the tool. And also something that tells you that something weird is going on here. Return on equity is very high. This happens when you have a lot of net income compared to the total equity of the company. Generally speaking, your company increasing their net income is good. I mean, you are fine with that. But when they are decreasing the total equity, this number will be higher. And this could be happening because they are getting a lot of debt, so they have more liabilities. They had the same assets, but more liabilities, so they have less total equity. And so the return on equity actually increases to a point that is stratospheric here. Again, we are using these deep dive ratios here to get a sense of what the company is doing. And using these, we can actually analyze it to the core using the financial statements. This serves sort of like a guide of what to look at here. I have already told you some of the things that deserve some specific deep down here, and this is what we're going to be doing next. But before that, we can examine the dividend yield as well, which is sitting at 1.5% right now, with a very low free cash flow payout ratio and pretty much net income payout ratio. I always like to take a look at the dividends tab here to see whether there is any special dividends being paid. Right now, that doesn't seem to be the case. It's basically a company that is paying some dividends here and there, pretty much, but they don't seem to be like super regular here, so you have to bear that in mind. Okay, so that's because of the dates that I'm seeing here, pretty much. So if we go back and actually examine our income statement here, this is when it starts to become interesting here. 2.7 in revenue to 4.9 in revenue in 2021, and net income of 151 to 624. So pretty nice growth and increase in terms of what the company has been doing financially. This is something that we like to see. More sales, more net income, very normal stuff. Now, what's the story behind the balance sheet here? You will see if I quickly go down, that the total equity is positive here. But if you take a look at the quarterly over here, you will see that the total equity has turned negative, and this is why we're getting the very current price to book value being negative here. And why is this happening is what we want to realize here. Now, we do know the company has been buying back shares. The additional paid-in capital values here have been negative, and so this means that the company has been accumulating shares, not issuing shares. This would be positive if they were issuing shares here. And so that's a good thing. It may actually be decreasing equity, but it's a good thing because, again, you have less ownership overall, not yourself. I mean, the total ownership of the company, total owners of the company are less, pretty much, proportionally again. And another interesting thing here that you will notice, take a look at the total debt line here. Remember, these are quarters here, Q1, this is just a year pretty much. And so if you take or actually 5 quarters. So if you take a look at the total debt here, 2.1 billion to 3.2, that's more than $1 billion increase in terms of the total debt. And proportionally, that's about 50% increase from this kind of debt here. So that's a lot of increase in terms of the debt that the company got. Now, is that a bad thing? Maybe not. Maybe they wanted to get some extra inventory out of that, or maybe they thought that they can utilize this cash to buy back shares, for example. So you kind of need to kind of read through the lines and see how the company is operating and what they are doing. But it's good to know what they're actually doing here in terms of their financials, and you can kind of use these statements here to very quickly understand what is happening within the company. Now, I already know that they are dropping their equity because of extra debt and buying back shares. But what is happening in terms of profitability and cash? This is what I want to examine. And you will see here a net income that is being laid out top line in the cash from operating activities. And then we are getting to the net cash provided by operating activities here. And you will see that it's getting more and more positive, which is of course a nice thing to see. And over here I wanted to point out something about this change in working capital, which is a very, very important thing in terms of these kinds of inventory, how do you say, like inventory, important companies, companies that are actually high on inventory, in many cases, intensive, I wanted to say, inventory intensive companies, pretty much what I meant to say for the most part. This kind of line can actually tell you here what kind of change in working capital happened through the previous period, reported financial period. And what does that mean? Now, working capital is basically the difference between current assets and current liabilities. So what does that imply? Remember that current assets are about the assets that can be converted into cash in the next 12 months. So basically, easy to liquidate, that means. Easy to convert to cash. And the current liabilities are the ones that need to be fulfilled in the next 12 months. So basically, using working capital, we can deduce what is the current liquidity of the company. Now, it could be negative or it could be positive, and both things can be fine, actually. But it can give you the story behind what the company is actually doing. Because a change in working capital that is negative here means that the company spent money. Remember, this is the cash flow. This is the cash from operating activities, the cash flow statements. It's all about cash here. So the company spent 90 million, actually more than the previous working period, the previous fiscal year, pretty much. Now, if we take a look at the balance sheet here, you will notice that back in the previous period, you can take a look at the total current assets and total current liabilities. And if you do the deduction between those, total current assets minus total current liabilities, you will get a value of minus 6 million here. And if you do the same for this year, you will get a positive value. It's about what, like what, 120 or something? No, 220, something of that sort, million over here. It's 1.2 billion minus 1.05 over here. So what does that imply? When we're getting a higher value here in total current assets compared to the total current liabilities, this could, for example, mean that the company is accumulating more inventory here. And in order to accumulate more inventory, you have to spend cash. You have to actually spend money in order to get this inventory. So this deduction in cash increases our inventory. And now this can kind of tell you here that the company is willing to depart with some cash in order to increase their inventory levels. For example, this is something that this can tell you. There are other things, like for example, the net receivables and account payables here. So for example, if the company decides to stall, actually take some more time to pay their account payables to their suppliers, this means that they are actually keeping cash, keeping more cash reserves. So this is something, this kind of change in working capital, and generally speaking, the working capital can tell you what the company is doing in terms of how they are acting with their inventory, with their cash, with their accounts payable and accounts receivable. And sometimes you could be seeing negative net working capital, for example, and this could actually be a great thing because some companies require to do that. Like for example, a company like Walmart, more than likely in many periods will have negative working capital because they are increasing their inventory levels, while a company like Apple, for example, will likely have a positive working capital because they don't need to be hoarding all this inventory really. And so this kind of shows you the relationship between cash and the working capital that the company has. It's useful to know, and I will make a dedicated video about the cash flow statement, which is upcoming next at some point. I hope it takes some hours to finish this one, but I will be describing that in a little bit more detail, but hopefully this can kind of give you an idea of how to examine the cash flow statement here and make some deductions about what the company is doing. Okay, so the cash from investing activities here is in the negative, as you'll see, and of course we examine those. It's about the company pretty much acquiring some stuff, and also financing, getting a little bit of debt is what we saw as well. And the free cash flow has been doing good, has been doing better and better, but what about the price to pay for this company? Now, the revenue growth has been a little bit all over the place. Lately it has been doing better. But in this kind of period, I want to be a little bit more hesitant and a little bit more conservative. I will go 8, 10, and 12 here. Of course, you can go higher if you want, or even lower. And the net income margin, again, has been a little bit, again, all over the place. Lately, the company seems to be doing better. But again, we want to be conservative. So I still will go maybe around these averages here. And I will go like 10, 8, 10, and 12. This would probably make a lot of sense. And in terms of free cash flow margin, a company that has very, very similar free cash flow margins, I love to see that. This is something that I really like seeing in companies. And I will go with something like 90, 100, and 110. And an annual return of 13% is what I typically like to make. And if I hit calculate here, you will notice that the company, oops, I think I made a mistake here. What was it? Well, yeah, this one. This is too high, that's why. So, okay, so I need to be making more than 3%. 13% is much better. So, the current price of the stock sitting at 25 almost bucks, and the low estimates are pointing to a max price to pay of $36, a medium of 55, and a high of 79, 78.6. And so based on what we have already seen about the company, apart from the fact that they seem to be getting some debt, which they may be doing on purpose, and they may be doing it to stock up with some inventory, for example. This is what at least the latest period seems to be implying, and that could be actually a good thing. I would probably buy this company. It looks good to me. I don't have much reservations based on what I'm seeing. Of course, it always helps to examine these companies in even more detail if you really want to. But in this video, I'm trying to deduce what to pay and how to analyze a company based on their financial statements. And I firmly believe that you can actually really evaluate a company just by using these values without even having to look into the nitty-gritty of their daily sales and daily pretty much operations. It helps a lot, of course, if you can get this kind of access. But typically, many investors tend to kind of wishful think about these things and not really have the actual connections needed to know what is happening within a company's operations. Of course, it's tough to know these things unless you are friends with the CEO or something. So this kind of financial statements and analysis through these numbers, careful examination, can actually tell you a lot of things about what the company is doing. And then you can decide on your own, what to pay for them, or if you want to acquire them or not. A little bit of a lengthier video. I thought this was interesting though, mentioning some extra things because this kind of company would actually require this kind of analysis here. And so I hope this was useful to you. Please remember to leave a like if that helped you a little bit, and subscribe if you are not a subscriber already, and I'll see you in the very next video. Thank you for watching this one. I'll see you soon, guys. Bye bye.